In a market expensive as it is right now, with stocks reaching record levels and many companies being valued at pretty high multiples in many different areas, with not the level of growth that you'd kind of expect to see at that level, it's hard to find valuable stocks. I think BCE is an interesting value proposition due to its position in the Canadian market and the telecommunications industry, its performance over the past year, and how well it provides cash flow through its dividend yield. Now, this isn't a recommendation to go out and buy the stock. This is just my thoughts and analysis on the company and how the market is going. If you're interested in it, I'd advise doing your own analysis and seeing what you think of the company and its financials, and then moving forward from there. I have another video where I do a full valuation through different analysis of the discount cash flow, dividend discount model, but I'm not going to focus on that here. This is just more technical stuff and some statistical numbers that I'm going to be looking at. So currently Bell is trading at just above $55, that is in Canadian dollars, with a market cap of just under 50 billion. Over the past year, their stock is actually down 15%. So that's pretty sharp contrast to the rest of the market that's actually seen relative good gains. You look at the S&P 500, really strong gains, but the telecommunications sector really hasn't done as well as other areas of the markets. But what really Bell provides that others don't is that high dividend yield. So if you look at their forward dividend here, it's 350 over the forward at a yield of 6.38%. That's a fairly high dividend yield. They just increased their dividend to that from previous. It's about a 5% increase overall. So it's a pretty high dividend yield, so you can expect cash flows. That's where I stress that most of your value would come out of this company. You might see some growth in the stock price over the next years, but a lot of the growth is going to come out of the dividends, as they have seen a lot of growth in their dividends, and I expect that it might continue at the same path into the future, but I'll discuss that a little later. Now, what makes Bell an interesting value proposition to me is that dividend yield and its relation to the rest of the markets. So what I'm going to be looking at is how it compares to the capital asset pricing model. So if you take a look at CAPM, pretty standard formula in finance to calculate what rate of return you can expect on a company, and if it's overvalued or undervalued. So it's basically, you have risk-free rates, which is RF, plus the beta times the return of the market minus the risk-free rate. So that would be the equity risk premium times the beta. Generally, the risk-free rate would be the government 10-year. So I have a Canadian 10-year currently is at 1.21%, so fairly low there. Moving on to the equity risk premium. So this little section here, and going with NYU's professor Aswat Moran, he calculates a forward equity risk premium every month. Advise you checking out his stuff. It's pretty interesting. And for February, he's got a one at 4.76%. So in total there, you achieve with a beta of 1, so the market rate of return you'd expect then would be 5.97%. So then looking back on BC, you notice that the dividend yield is at 6.38%. So then your question has to come to, well, what's the beta? You could look at this beta here, 0.3. I would suggest that is an accurate beta, as it does calculate a lot of noise. I'd use a more accurate would be to compare how the market is doing overall in that sector. So you look at all the companies and the peers and see how well they did. This is just taking a look at the work I did for the valuation. I did about 2 years on Bell. So this info all here isn't going to be accurate. It's not up to date. I'm just showing you kind of what to kind of expect from the industry. So overall, I had an unlevered mean beta of 0.41 and a relevered beta of 0.579. So not very high. I expect the beta could be slightly higher now. It's hard to say. I'd say max though, about 1. I can't see it going above 1 in any scenario, especially how the telecommunications industry operates in Canada, how it's hard for new competitors in. So in a way, you could kind of think about them almost like a utility ways. So I'd say they're fairly safe industry to invest in, especially with that kind of low beta and the high dividend yield that they have. So previously I had a cost of equity of 5.3%, but that was also with a higher market risk premium and a higher risk-free rate. So expect that to drop, as I've shown you before, even with like a beta of 1 with a market risk-free rates and equity risk premium, you'd still see that surplus in value you'd gain from the dividend yield going forward, not to mention the growth that you'd get from that dividends. But I'll talk about that a little later on. Here's just to show you how the dividends have changed over the years. So currently, the current dividend is at 83.25 cents a quarter, and it's looking for that for the next 4 quarters going forward. I mean, things could happen and dividend could get reduced. That is always a risk, but they have strong cash flow. While it looks like a lot of their cash flow is going out, they have a higher than 100% payout ratio. It isn't quite calculated that because that's not their cash generated. It's a better look to look at their free cash flow versus that, which is at a more stable position. But as you can see, it was up from 79 and a quarter cents, just over 5% increase. Previously, then it was a 0.755, which is also about a 5% increase. So you can see that there's steady growth going over the past years. So you have some reason to expect that the dividend will continue to grow over the time. But even then, it's still at a high enough dividend level at the price that unless the dividend decreases in the future, it seems like a pretty good option to consider. On the riskier side, it is should note that the revenue did decrease due to the pandemic. As you can see here, for 2020, they had revenue of under 23 billion, which is lower than what they got from the previous 2 years. So you've seen a decrease in revenue, but they, from their earnings call, they do expect that they'll be back to similar levels in the coming year. Their net income is also saw a decent drop. And some other risks I would say is that the introduction of 5G will cost a lot, so infrastructure will require high spending, and the possibility of maybe some new tech, something forcing telecommunications out of the industry. But up here in Canada, the telecommunications industry is in a unique position, not a lot of competition, and they're basically backed by the government in the sense that they get funding. There's a CRTC, which basically regulates the whole industry and makes it pretty much hard for anyone else to try and come into the market unless it's a Canadian company. Now, those are just my thoughts on what makes BCE Inc. an interesting value opportunity.